major banks are currently taking on heavy losses. This is only going to accelerate the current stock market crash, the current recession, and it will cause some major institutions like Bank of America to end up going bankrupt. So stay tuned and let's make some money. And now I want to dive straight in with the key information. So, CNBC released this article that says Bank of America and Citigroup have been flagged for potential losses on risky loan deals by rival JP Morgan. It says leveraged loan funds have recently seen their steepest outflows since the depths of the pandemic back in 2020. This means that risky companies and new tech startups that are generating little profits or taking on heavy losses are defaulting on their loans, meaning that major banks are taking on heavy losses. It says, meanwhile, JP Morgan and Wells Fargo, who are the second and third biggest players, have only been involved in 2 deals where the borrower has so far defaulted. This means that Bank of America, Citigroup, and likely Credit Suisse as well are lending to the most risky of risky companies. These 3 banks are taking on the heaviest of losses, even though they haven't lent out the most capital. And it says if market conditions suddenly change or continue to worsen, the bank providing the credit line may be forced to eat losses to sell the debt at a deep discount or hold on to the loans in hopes the market recovers. And the Financial Times is saying that in terms of corporate debt, leveraged loan holders or leveraged loan issuers are praying for a soft landing because increased cash flows are of little use if the issuers or the borrowers end up defaulting. But Unusual Wells has tweeted saying that markets are dropping as Powell stated that rate hikes may cause a recession. I also found an excellent little video or an excellent little GIF here that perfectly explains Jerome Powell's soft landing. He said, "Our goal is for a soft landing, but it's going to be very challenging." Obviously right here we can see this plane taking off, has a little bit of an accident. It prepares for a soft landing that wasn't quite so soft. The Financial Times article says not everything in fixed income securities is as nailed down as the name. Leveraged corporate loans with floating rates have been amongst the hottest debt products marketed on Wall Street in recent years. It says financial engineers rigged up so-called collateralized loan obligations, aka CLOs, aka CDOs, synthetic CDOs and CDO squared, but not for the mortgage market, but for the leveraged loan market. They've bundled pools of corporate loans into slices of varying risk. Many of these loans were priced at a spread floating above a benchmark rate. It says trillions of dollars of these loans were issued, well ahead of the junk bond market. Insurers eagerly swallowed the senior ranked paper. But now these risky loans are starting to go bad. These major institutions have loaned out trillions of dollars worth of cash to these risky companies, and now they're starting to default on the loans. And it says the question investors need to ask themselves is this: how valuable is inflation protection likely to be once they've already written off the cost of paper that became worthless? Guys, if you sign up to Moomoo right now using the link in the description below, you can currently get 10 free stocks worth up to $25,000 in total and a guaranteed free shares of Lucid on top of that. And if you didn't already know from Moomoo's latest customer agreement, they state they do not accept payment for order flow. They state they do not generate profit from selling order flow. They state they do not generate profit from lending out your securities. And they state they do not sell orders to market makers like Citadel because they route their trades themselves through Futu Incorporated. Otter tweeted saying it's officially a bailout for BlockFi, which begs the question, why do they need a bailout if they didn't lose depositors' money? And he said, how much more will Profit Maxi FTX bail them out for if the $250 million is spent? Now, the Financial Times published this article saying crypto exchange FTX bails out the lending platform BlockFi. The rescue prompts comparisons between chief executive Sam Bankman-Fried and a crypto central bank. It says the FTX chief has lent out an extension of $250 million to BlockFi, and it's led to him being likened to a lender of last resort for the crypto industry. Now, you may also know that FTX bought a massive stake in Voyager Digital, effectively bailing out Voyager over the last few weeks as well. But Unusual Wells has just tweeted saying crypto broker Voyager Digital says it faces exposure of about $660 million to troubled digital asset hedge fund 3 Arrows Capital. So therefore, FTX has just bought out Voyager Digital and has now instantly suffered a $660 million loss. Now, if BlockFi spend the $250 million investment that FTX has just made, then FTX will be down nearly $1 billion in only a few weeks. FTX seems to be propping up practically insolvent crypto companies, and it won't be long until FTX runs out of money as well, and its investments end up imploding. I think when FTX implodes, and BlockFi implodes, and Voyager Digital also implode all at the same time, Bitcoin will crash to below 10k per coin, and Coinbase will likely implode at the same time as well. And I think when Bitcoin falls sub 10k, because it's been tracking the S&P 500 so accurately, the S&P 500 will fall as well. All of these hedge funds have tons of money invested into crypto still, even though they've taken out tons and tons of money over the last few months, causing the crypto crash, they still have more money invested. And obviously if their crypto money gets vaporized, then their investments in the S&P 500 and in blue chip stocks will be vaporized as well. And obviously if all of these long positions in crypto and in the S&P 500 end up being vaporized, it will cause more hedge funds to be liquidated, forcing them to close out of their shorts as well. Something that I speculated a few videos ago was that Credit Suisse was holding kohrs' short positions, potentially in GameStop and in AMC, and this research from Dragon Breath actually proves it. It says CRM Director of Hedge Funds, admission that kohrs' corporation in bringing us shorts took an $800 million P&L hit in Credit Suisse's portfolio during the GameStop short squeeze. It says the CRM Director of Hedge Funds acknowledged kohrs' corporation in bringing us shorts. It says you'll recall they took an $800 million plus P&L hit in the Credit Suisse portfolio during the GameStop short squeeze week. Credit Suisse said we were fortunate that we happened to be holding more than $900 million in margin excess on that day, so we suffered no resulting margin call. But since then they've pretty much swept all of their excess, so they think there's a prospect or a possibility of a further $700 to $800 million margin call that is very real if we see similar moves once again. That means that Credit Suisse is likely still holding their shorts or still holding kohrs' shorts on GameStop and on AMC, and could see a further $700 to $800 million margin call if GameStop and AMC run up again. A $700 to $800 million margin call would mean that Credit Suisse would be forced to buy back nearly 100 million AMC shares at the exact same time. Credit Suisse buying about 80 million shares of AMC at the exact same time, I think would absolutely cause the short squeeze. Now we know that so far these major institutions, these major hedge funds and these major banks are being kept on a thread by the Fed with their money printing programs like the repo market and the reverse repo market as well. And Jan Jacker said if the Fed totally stopped its money printing programs of quantitative easing and the repo market, Wall Street banks such as JP Morgan, Goldman Sachs, Citibank and Credit Suisse and others would go under. And he said they'd be forced to stop supplying infinite liquidity to those insolvent hedge funds or the hedge funds that are practically insolvent and those brokers. And he said that's exactly what we need for the entire gambling house to come falling down. And speaking of which, looking at the reverse repo market, we've again hit a new all-time high, a new record of $2.25 trillion. Since the back end of May, we've increased from only 1.8 trillion all the way up to 2.25 trillion, nearly 2.3 trillion. That's a $500 million increase in the reverse repo market in only a few weeks. And again, looking at this reverse repo chart, it did increase fairly rapidly until October, but then plateaued from October until early March. But since March, it's been absolutely skyrocketing once again. I don't think it'll be long until these reverse repos hit 2.3 trillion, 2.4 and 2.5 after that. But I do think there's only so much money they can continue to print before they just lose control. And as Bloomberg says, Morgan Stanley and Goldman strategists are seeing more stock market losses. SG's Cabra sees the S&P 500 sinking an additional 30% in 70s style stagflation. Now it says US stocks are staging a furious rally on Tuesday, which was obviously yesterday, but top strategists at SG and Goldman Sachs warn of more declines ahead as equities have yet to fully price in the risk of the coming recession. It says a 1970s style inflation shock could send the index crashing about 30% from current levels, aka currently down 20% and falling an additional 30%. Morgan Stanley is expecting the S&P 500 to drop another 15 to 20% to around 3,000 points for the market to fully reflect the scale of the economic contraction. And he says the bear market will not be over until the recession arrives or until the risk of one is extinguished. Basically saying the market will continue crashing almost non-stop until recession actually arrives and effectively destroys the economy. Now obviously the S&P 500 continuing to crash just means that these hedge funds are edging ever closer to that liquidation point. And obviously when they are liquidated, they will be forced to cover their short positions, causing the AMC squeeze. And finally, I think Gollum Stocks has given a perfect example of what I've been trying to explain. He said, who here knows what a stock tsunami is? He said, like in nature, where the water gets sucked out into the bay before rushing in, causing mass destruction. He said it's blue chip stocks and it's the AMC shorts covering AMC when the tide and liquidations come rushing into our accounts. Basically meaning the market is steadily crashing as the water slowly gets sucked out into the bay before this massive wave of liquidations happen, causing the AMC short squeeze. And Warren Buffett also gave the perfect analogy as well, saying you only learn who's been swimming naked when the tide goes out. Basically meaning as the market starts slowly crashing as the tide goes out, you very quickly learn who's massively over leveraged and who ends up being liquidated first. But guys, be sure to let me know what you think down in the comments below. Also guys, be sure to ding that notification bell because that way you'll be alerted when I upload a new video. Cheers.